When we're thinking about investments in real estate and development, building a new building or project, one of these kind of rules of thumb that comes up a lot is the ratio of the finished project value to the land cost. If you look at housing, if you look at commercial development, you see a fairly consistent ratio that the cost of the land can't be more than, call it 20 to 25% of the overall project cost. So if you're going to deliver a project that sells for $1 million, the land is typically less than 20 to 25% of the overall value of that finished project. So for $1 million project, you're going to see land prices at the $200,000 to $250,000 range. If someone's buying a site for $1 million, it's very unlikely that you'll see total value of the finished project to be less than 4 to 5 or even $6 million. And with that ratio of 4 to 5 to 1 or 20 to 25%, however you want to think about the math, I think that gives us a hint, as I discussed in another video, of how we can impact the final cost of a project. If you want the final cost of a unit of housing, for example, to be lower, while we can't control the overall price of the land because that's based on market dynamics and economics, you can't control the price of the land, but if you can take the cost of the land and cut it up into enough pieces, right? So if you have $1 million parcel of land and you want, let's say, $1 million homes, you can't build $1 million home on $1 million piece of land. That just doesn't work. Your cost would have to be negative to account for a profit margin. But if you could build 5 homes on that $1 million piece of land, well, now your land cost per home is $200,000. And again, at that 4 to 5 ratio, which you very often see, $200,000 in the land, you could build a home that sells for roughly $1 million. Now, if you go higher than that, so you say it's a $1 million piece of land that allows for 10 homes, now your land cost per home is $100,000. You can afford to invest money and build a home that say costs $200,000 to $250,000 in cost. So now your all-in cost is $300,000. You could sell that for $450,000. So now your $1 million piece of land with densification could allow for the delivery of homes that are less expensive than that original parcel of land was bought. The challenges you see often when we don't allow for densification is a home sells and can only support one home. So you either see someone buy an inexpensive home, invest in it, and sell it for a higher price point. And in extreme cases, you may see if the market has moved so much, and that is a very, let's say, not very taken care of property. It's kind of the worst house on the block. If the market has moved so quickly, so fastly that you could buy a $200,000 house on a street where the homes are selling for $1 million, again, that's a 5 to 1 ratio. You may see a single family home torn down and replaced by another single family home. Again, it's going to be much larger, much more expensive. And that only happens when the market moves and the future value of the home is 4 to 5 times what the original home value was. So that's why in really expensive neighborhoods where the kind of top of the market housing, you rarely, if ever, see a home torn down because, again, the market doesn't support, if you had to buy $1 million home, that neighborhood probably doesn't support $4 to 5 million home prices. So even if you built this massive home on this $1 million piece of dirt, you wouldn't be able to sell it for what it's worth. So nobody would really build that. And kind of reversing it, if the neighborhood supports $4 to 5 million homes, you probably can't buy a parcel that supports a single family home for only $1 million. You may be able to buy it for 2 to 3 or 3 to 4, but again, you wouldn't see kind of a replacement of that existing single family home, a 1 to 1. But if your neighborhood or your city supports $4 to 5 million homes, what if you could buy a parcel and split it up into 5 or 6? Well, you could have homes that were much less expensive than $4 to 5 million on that plot of land, where before the only thing in the neighborhood was multi-million-dollar houses. You could have single-million-dollar houses, or take the math down. If you're at $600,000 neighborhood, if you allow for densification, the numbers could be dropped and you could support a variety of price points in an existing neighborhood. So again, one thing to always remember in this kind of back of envelope calculation when you're thinking about land value to finished development value, you'll very often see this ratio of 4 to 5 to 1. The total cost of the project is going to be 4 to 5 times the cost of the land. So if it's a redevelopment opportunity, if you buy the site with an existing building on it, you'll often see what's replacing that initial building, or sorry, that original building is something that is 4 to 5 times the value of what they paid for that piece of land with the building on it. So if they bought it for $1 million, you'll often see a project that is valued at $4 to $5 million on top of that, whether it's one bigger building, whether it's home or commercial, or several buildings at a much denser or higher density, a density of 4 to 5 times as much. Something to think about, and again, you see it pop up all the time. If you've got any questions about this 4 to 5 ratio or 20% ratio, leave them in the comments below because I'd be happy to share my thoughts.